Hello, friends. Welcome to my channel on option trading for beginners, where I plan to cover option trading just for people who are starting out on the options trading journey, or people who have already been doing it for some time and want to know more and excel in option trading. Um, so, this channel is essentially for those people. Um, Couple of quick disclaimers. I'm not a financial advisor, or I do not have any authority to recommend any stocks or options. So anything that is said on my channel or discussed here is primarily for information and education purpose only. So with that in mind, let's get started. We will start with some of the basic concepts on options trading. So let's just jump in. So first of all, let's start with the what is option, right? What are the options? So options are essentially financial contracts that gives the holder the right but not the obligation to buy the underlying asset, which could be a stock, it could be an ETF, it could be a commodity index, anything. And since these are financial contracts, you do not hold anything at the end of it. Like when you buy a stock, you actually physically hold ownership, part ownership in that company. For example, you buy a Microsoft stock, you basically part own the company because you bought the share. Whereas in options, this is purely a financial arrangement where you basically um, buy the right to either sell or buy the stock based on certain conditions, and we'll come to that in a moment. But for now, just remember that these are financial contracts only and do not have any physical bearing on it. So what are the types of options that you can do? So basically there are call options, there are put options in a very simplistic term, and then there are multiple ways you can play the calls and puts. We'll go and look at that in detail in the later part. But for now, just remember that there are call options, there are put options. In call options, you give the holder the right to buy the underlying asset at a strike price before expiration. Now, what it means is that when you buy a call option, right, or a sell call option, you have the right to buy that underlying asset before a particular date on which that contract is set to expire, and that's called expiration date. And you agree to buy that at a particular price as per the contract, and that price is the strike price. Similarly, for put option gives the holder to the right to sell the asset, um, again at a predetermined strike price as per the contract before the contract is expiry date. So very high level, calls and puts, two types of options, and it gives you the right but not the obligation either to buy or sell shares. So just keep that in mind for now, and then we'll delve into detail later. So before we jump in, it's essential to understand some basic terminologies because these terms are used over and over and during the options trading. So let's understand what the strike price. So what's the strike price? When you exercise an option, or when you buy or sell an option, you enter into a financial contract, and that contract is at a particular price. So that price is a strike price, and you are bound to either buy or sell the shares at that strike price, which is the contractual price. Expiration date, this is the date on which the contract is set to expire. Right? Option premium. What's option premium? So option premium is basically the amount of money that you either pay as a premium or you get paid as a premium because of the buying and selling of option. So this is the price at which the option is either purchased or sold. Now, the three concepts below, in the money, out of the money, and at the money, are very important concepts you need to understand. and this will be better understood when we look at the real example later in the video. But for now, let's understand, whenever you say my option is in the money, what it essentially means is that the the stock price is lesser than the strike price for if it is a call option. If it is a put option, it's just the reverse. Your strike price is less than the stock price. When you say the contract is out of the money or option is out of the money, which means that the stock price is more than the strike price. So that's out of the money for calls, and it's opposite in when it is in terms of puts. At the money is when your stock price is same as the strike price. So that's when you call your contract is at the money. Assignment. This is the this is used when you are obligated to buy 100 shares, which is one contract. Exercise is when you're obligated to sell 100 shares, which is again one contract. Right? Some of the basic terms. And then, of course, don't worry about it too much. We will look into it in detail when we go to the actual example. So let's go a little bit in detail about what the uh, why the options are used by people. Primarily for three purposes. You can generate regular, daily, weekly, monthly, quarterly, annual income by selling options. So it's an income generation tool. It's also used for hedging, where you can use it for protecting your portfolio against downturns, market downturns, and you can use it purely as a speculation. Leverage your positions at a lower cost than buying a position, buying actual physical shares. You can speculate and then buy and sell option contracts. So primarily, these are the three main reasons why people delve into options. At a very basic and high level, there are four types of options that any beginner or intermediate option trader needs to look at: long call, long put, covered call, and cash secured put. These are the four basic option trading strategies, based on which there are other advanced strategies which are built up, such as vertical spread, straddles, strangles, condors, and lots of them. But we'll cover them as we go further along. But for now, just remember that there are four basic option trades that you can do. Long call is the right but not the obligation to buy 100 shares, which is one contract. So when I say 100 shares, always one contract, because one contract is 100 shares. So long call is right but not the obligation to buy 100 shares of underlying stock at a strike price by expiration date. Long put is right but not obligation to sell 100 shares uh, of an underlying stock at a strike price by expiration date. When you are selling a covered call, essentially it's called it's also called selling a covered call or a short call. When you sell a covered call, it is basically your obligation to sell 100 shares of underlying stock at a strike price by expiration date, if if the option is assigned to you. And then cash secured put or a sell put, or it's also called short put. This is essentially when it's an obligation to buy 100 shares of underlying stock at a strike price by the expiration date if you're assigned. So these are the basic four operations or trades that any beginner or intermediate trader would start with. And then a combination of these different four different trades would result into strangles, straddles, spreads, condors, and different types of strategies that you can build on top of these four basic pillars of option trades. Now let's get further detail in terms of how this whole thing works. So option at a highest level can be done two ways. Either you can buy an option or you can sell an option. Essentially, whenever you buy an option, you pay money. So just remember that at a highest level, that when you say I'm buying an option, you pay money. And when you say you are selling an option, you earn money. Just like in any other commodity, when you go and buy something, you pay for it, and whenever you go and sell something, you get paid. So it's very similar to any transaction that happens, not just in the stocks, but in any commodity or anything in in the real life. When you buy and sell, when you buy, you pay, you sell, you get paid. When you buy, there are two types of option buys that can be done. You can either buy a call or you can buy a put. Now, when do you buy a call? When do you buy a put? You buy a call when you expect the stock price going up in the near future. You buy a call. Now, it can again be, you can buy a call for a day, you can buy a call for a week, 2 weeks, 6 weeks, a quarter, a year, or multiple years. And all of these instruments can be used for buying at any time frame, ranging from 1 day to 1 year to multiple years. When do you buy a put? You buy a put when you're expecting the stock price movement downwards. When the stock price is expected to go down, you buy a put. And this is also hedging for, if your stocks are headed downwards, this is essentially a um, uh, hedging strategy that you typically do when the stock market goes down. When the stocks go down, you essentially buy a put. Now, as I said, all the buy sides are when you pay. How do you earn? You earn when you sell. So what do? You sell a call. Now, call can be sold in two ways. You can either do a naked call when you don't own the share, but you still sell a call without owning it. That is called naked call, which means that you buy it without owning it, and then if they're assigned, then you have to actually buy from the market and um, give it to the person, or sell it to the people who bought it from you. So it's a risky strategy, but there is also a second type of um, call that you can sell, which is called covered call. Covered call is a safer bet. When you own 100 shares of a individual stock, you essentially sell a call on it, which means that you agree on an option contract where you say, I'll sell my 100 shares at a particular strike price at a particular expiration date, and you get paid for it. You get a premium paid for it. You can also sell a put. When you sell a put, essentially you uh, you have cash in your account, and you use that cash to say that I'm going to buy these 100 shares if the shares come to a particular strike price that you enter a contract at on a particular expiration date or before the particular expiration date. So when you sell that put, you're essentially getting into an agreement to say, I'll buy these shares, right? Now, these colored arrows that you see essentially show the market direction. So when the stock goes down on a red day, you can sell a put, you earn good premium. On a green day, when the market is going up, you can sell a call and you earn a good premium. So these are high level indicators of when do you sell a call versus when do you sell a put, when do you buy a put versus when do you buy a call. And then, as I said, these are basic building blocks of any option trading strategy. And then, based on these basic operations, there are some advanced option strategies like spreads, Condors, Strangles, Straddles are built on. One easy strategy that is used by a lot of beginners is wheeling strategy. Now, what happens in a wheeling strategy is, as you can see here, the wheeling really starts with selling a cash secured put. So remember this, you can sell a put here with the cash that you have. Let's say you have $10,000 or $5,000 or even $1,000, for example, right? You can start with as low as 500 to $1,000 because you need to own 100 shares of any particular stock. So you need to have at least 100 shares in your account, or have a cash equivalent to those 100 shares so that you can sell cash secured put. So the wheeling starts with cash secured put where you sell a cash secured put. You say that I'm going to buy a stock of, let's say, Palantir, for example. I'm going to buy Palantir at a particular strike price at a particular expiration date. So you sell a cash secured put for that. For selling that, you need to have cash in your account, which is equivalent to buying 100 shares of Palantir on a particular date, let's say today. And when you enter into that contract, when your contract get filled up and you have a cash secured put in your account, which is sold, you earn premium. Now, once you earn that premium, that is for you to keep, and then you just do nothing. You just wait for expiry of the contract. Let's say the expiration is in 2 weeks or 4 weeks. You just do nothing. You just wait and watch. Now, when you, since it's wheeling, you move forward. Let's say it's a 2 week expiration. 2 weeks come in. Now, at the expiration date, two things can happen. Either your strike price is breached, which means you said I'm going to buy Palantir at, let's say, $15. Right now, the current price is 20, and you say I'm going to buy it at $20, and therefore you sold a cash secured put for 15. Let's say Palantir hits 15 on the expiration date. So you get an assignment, which means you have to buy Palantir shares at $15, which means 15 multiplied by 100 shares. Remember, one contract is 100 shares. So you sell, so you buy 15, you buy 100 shares of Palantir at $15, which means you have to pay $1,500, and the shares become yours to keep in your account, and you get full premium. So whenever there is an assignment of 100 shares, you keep full premium. Or second scenario is when Palantir share doesn't hit 15, and let's say they end up at 17, which means your option expires worthless and you keep the full premium. So in both these cases, you keep the full premium. The only case when you do not keep the full premium is if you close the contract early, which means that you buy your cash secured put before the expiration date, then you will have to keep part of your premium. Depending on what the premium is on that day, you will only keep part of it because you will also have to pay back for buying your cash secured put. So in that case, your premium will be in part. You will not have full premium with you. But on the expiration date, you keep the full premium if there is an assignment of those 100 shares of that one contract to you, or if your contract expires worthless. In both the scenarios, you keep your full premium. So when, if you, let's say if you are assigned 100 shares of Palantir, what do? Next, you sell covered call on it, which means you make a contract to sell those 100 shares or one contract to your counterparty and earn premium for it. Right? So again, the premium is yours to keep when you sell a covered call on those 100 shares or that one contract. And then what do? Do nothing. Wait till the expiry. And what are the outcomes possible around expiry? Again, three options are possible. Either your shares will get sold on a particular strike price that you entered on a contract, um, and then you keep the whole premium, or your contract expires worthless. Again, you keep the full premium in the second scenario. And the third scenario is when the price is reached, or uh, your, the stock price is equal to the contract price or the strike price. In that case, you will have to sell those 100 shares. Again, you keep the full premium, but you have to sell those shares. And if they are not sold, they are for you to keep. And then premium is also yours, share is also yours. This is how the whole wheeling strategy works. And you can rinse and repeat this strategy as many times as you want and keep earning regular income. So I hope you like this. So friends, that was a quick introduction to options trading. You can call it a 101 of options trading. If you like the content, please subscribe to my channel, as I'm planning to post multiple videos on educating the option and trading strategies, various ways you can do things, and also we'll look at some trades as well, um, as we go and execute them. So lots to learn from my channel on options trading, lots to understand and get yourself educated, whether you're a beginner or intermediate options trader. So please like and subscribe to my channel if you want to see the content on this topic going forward. So I hope to see you soon. Bye for now.